Welcome everyone to 2026 FinTech Predictions. It's great to be back here with my friends and colleagues at Cross River for the third annual FinTech Predictions webinar. And really happy you all joined us today for what I think will be a really fascinating discussion. So I think we can all agree that it's really exciting to make predictions, but it's also important to look back on the prior year and understand where you were right and where you were wrong. So we'll start with that as well. But before we do that, I want to make sure you all know my colleagues. So Adam Galler, I lead FinTech banking at Cross River Bank. I've been with the bank for 18 years. I will start also with an icebreaker question. And the question to the colleagues will be, if you were not a banker at Cross River, what you would be doing with your career. So when I was an analyst on Wall Street, I was asked the same exact question. And I answered I would be an analyst on ESPN, which is my dream job. So passing it to Noah Cooper.
If I was not at Cross River and not in finance, I would no doubt be a high school baseball coach.
Okay, like the baseball player he was. Okay. And Hillel, say who you are and what you would do.
Sure. So Hillel Olivestone, Chief Strategy Officer. If there was something that I could do that wasn't what I'm doing right now, I think I'd be a chef. I love cooking, make dinner all the time, like making interesting food, so why not?
That sounds, all these are hard to beat. I'm Ben Melnicki. I'm the Chief Risk and Compliance Officer at Cross River. I've been here about 4 years. Before I moved into regulation, I was a trader. Wasn't a very good one. I'd probably still be doing that.
Okay, hopefully you're doing well today. The markets are doing really well so far. So I think we're going to start with looking back at 2025. When you all sat here last year, you made various predictions. We made various predictions. I think hopefully we were right on some, and we were definitely wrong on others. So maybe the first question I'll throw at you was, what was the biggest surprise for you in 2025, starting with Noah?
I think the biggest surprise is that we actually got some of our predictions correct. A broken clock is right twice a day in some instances. So the one we put forth last year is that we had a much more dovish view on what the Fed was going to do. At the time, the market was pricing in roughly 50 basis points of rate cuts. We had thought it was going to be closer to 75, and that played out. The principal reason behind that thinking really was centered around the size of the Fed's balance sheet. It had shrunk by over $2 trillion, and there's a general rule of thumb that every $1 trillion of Fed balance sheet is worth 100 basis points in policy rate. So even though the headline rate at the time was 4.25 to 4.5, adjusted for the Fed's balance sheet, it was actually closer to 6.25 to 6.5. And so that gave us confidence that given the employment picture, there would be a more dovish outlook, and the Fed did cut 75 basis points throughout 2025.
Okay, great. And Hillel, I think in your position in the strategy role, what surprised you last year?
So we were definitely expecting, with the new regime, the new administration, a change in regulators, a change in their view and how they work with FinTech in general. One of the things that I think surprised us was the speed with which they changed the regulations, opened up different types of opportunities for FinTech companies and banks alike to really do a lot of interesting things and expand the ecosystem in general of FinTech. So whether it be on the charter side, whether it be in regulation associated with stablecoin and crypto, whether it be access to different payment rails and different charters and different establishments, in the end of the day, the regulators really embraced the industry as a whole and tried to create as much opportunity as possible for the players, and that was quite surprising and quite welcoming.
Yeah, I agree. And Ben, you have a dual role. You are head of risk as well as compliance. Maybe in your view, looking back on the past year, what surprised you the most?
Yeah, I think it's a good question. I think we were right on this, dovetailing off of a lot of what Hillel said. I mean, I was surprised pleasantly, but how quickly regulators moved away from regulation by enforcement. I think it was a big win, and it happened a lot quicker than we thought.
Okay, great. I'll talk about mine. Last year I had a pretty negative view on the consumer in 2025. I thought with increasing rates, the strain on consumers' balance sheet would push them into a pretty desperate situation. I would say I was partially right. To know it's probably about a broken clock. I think that we've seen a shift in the consumer savings rate, which has definitely gone down. I saw a stat, I think it was yesterday, from a Bank of America report, that I think close to 50% of consumers today, if they had a $1,000 emergency, would have to borrow to cover it. At the same time, I think a report yesterday showed that 25% of consumers are living paycheck to paycheck. So I think that we've seen a shift in the strain, but I think the resiliency of the consumer, I think, has been surprising to me. And I think perhaps, talking to the rate cuts, if rates get cut further, if there's some meaningful relief in other areas, I think we could see some renewed strength. And obviously, the consumer spending is what drives our economy as well as small business. So I think that I have a more positive outlook on the next 12 months than I did perhaps a year ago, noting that, of course, we'll have to monitor both consumers and small businesses for continued strain and stress. And so that's looking backwards, and that's a little easier to do because you've seen everything happen already. I think the next 5 statements will be a conversation, and will be a little bit provocative. We'll make 5 bets, and I want to know from each of our panelists their view on those bets. So starting with the first one, bet number 1, fintech goes global without going physical. So I think this talks about the theme of expanding product set, expanding geography internationally, and maybe starting on the other side with Ben. When you think about international expansion, product expansion, from a fintech perspective, the ability to add products, add geographies without moving your physical border, what are your thoughts for 2026?
That's a great question, Adam. I think first and foremost, even coming out of the pandemic, the world is global. It's a global economy. So I think you have to have a business strategy and a product mix that actually services more than just your geographical region. I think technology is really what helps us get there. And if you think about the way that we're moving with technology, there's really a lot going on, and whether it's novel, nascent technology like AI and digital assets, but I think the product mix that we're seeing today is a lot more creative, and it's forward thinking. It's not myopic and geared to one just particular market. So I think everything should be with a global tint. Obviously, there's some variations where you need to be focused on a particular region, but I just think the times are right to scale globally and to look at the world from a more worldly view.
Sure. And Hillel, in your seat, we're doing a lot of planning around international expansion for our clients, but maybe how do you see the advancement in that expansion coming in 2026?
So to piggyback on Ben, for me it really starts with the infrastructure. And what we've seen over the last year or so is really the building of that infrastructure and now the adoption of that infrastructure. And what I mean by that specifically, mostly stablecoin infrastructure, digital asset infrastructure, real-time payments across the globe in general, really opens the door for companies to be able to expand their footprint from just being one geography to many. We're obviously embracing that here at Cross River and really enabling our customers to do that as well. So we really see the fact that just highlighting stablecoin specifically has really opened the door. We're embracing it, our clients are embracing it, and they're looking to expand their entire focus right now from one place to many.
Yeah, and we'll cover stablecoins later on as well. Maybe just to sprinkle in some audience questions that were submitted prior to the webinar. One question was, how impactful will stablecoins become for domestic payments? And this is my personal view. I don't necessarily see a huge impact domestically. I think the real impact will be internationally, and so we'll cover that more later on. I think we'll move on to the next topic now. We'll come back to the other questions later on. Bet number 2, embedded finance will explode in daily life experiences. I personally have a view that I think this is the wave of the future. I think that finance will move from being just a convenience to being in our everyday experiences. And that could be social media apps. It could be things that we utilize while we're driving. Any app that we're using on a regular basis will become where we do our finance activities. And so Noah, maybe starting with you, all brands want to be vertically integrated. Obviously, the idea of bringing fintech or bringing finance to customers versus customers going to finance is a theme. Talk about the impact from your perspective.
Yeah, I couldn't agree more with your sentiment. If you think about the constituents who are involved in this embedded finance arena, the end users or the borrowers, the SaaS platforms or the brands, and then the end investors and the assets. It's really positive for all three. Just going one by one, the end consumer or borrower or small business, instead of having to upload bank statements and show proof of sales and tax documents, generally all of the information that they have, that they are using in these embedded SaaS platforms is already vetted and right there. So it's a much more streamlined borrowing process for the small business or the consumer. From the lender's perspective or the marketplace or the brand, as you noted, Adam, they're meeting the customer where they are doing their finances. And so it creates this really nice mutual stickiness where the lender, the platform, and the brand are all acquiring the customer once and not acquiring the customer at disparate times. And then lastly, from the investor's perspective, there's real-time credit outcome data that's being witnessed in real time, and tweaks and changes can be made as sales change or finances change. And it's a sector that we as an organization are really leaning into, particularly in the small business space. Two platforms that we've worked with recently on the balance sheet side. One is Paraffin. They're an embedded SMB provider providing loans to small businesses through the likes of DoorDash, Amazon, and other vertical SaaS providers. And then as well as Fundbox. So Fundbox is embedded in the QuickBooks suite. Two opportunities we think are really benefiting all of the folks involved, and we think are really great investment opportunities as well.
You know, one of the more interesting trends in embedded finance is obviously prediction markets. And so maybe going a little off topic, but to Ben, embedded finance could be social media apps, could be other experiences like Noah was describing. But I think there's also obviously challenges associated with embedding finance into your daily apps. And maybe, Ben, from your perspective, what do you think are the biggest challenges, either regulatorily or otherwise, that you see as this progresses towards embedded finance being truly in your phone?
Yeah, it's a good question. It's funny. Prediction markets, you mentioned. You know, we're making predictions about things here. We said bets, but you know, prediction markets. Just taking prediction markets, Adam, I think, as an example. You know, whatever you think about gaming and betting, putting that aside, it's ingrained in a lot of our everyday lives, and whether you know you're taking views about current events, and I think things like that. What's happening is I think if you just use prediction markets as one sort of use case to it, is that everything is becoming accessible to you as the consumer. So, but what we need to remember is the existing regulatory framework still exists. So I think when you think about prediction markets and embedding it into finance and everyday consumer use, I think that everyone's finding a way to actually address the sort of regulatory perimeter into their package. And I just think prediction markets is one particular use case. Just to hit on it, is we're seeing that. You know, we thought, you know, in some cases it could be considered gambling or gaming, but when you break down at the end of the day, one view is it's a derivatives contract, and what we do at Cross River is we move money. So as a bank, I think we want to always try to find ways to embed the use case and provide banking services regardless of what the activity is. Yeah.
Again, trying to thread in some of the audience questions. The question was posed, what is upcoming at Cross River that will support this trend of embedded finance? I'm going to turn to Hill in a second. I will say that we are actively supporting those two categories. We mentioned social media platforms, we mentioned prediction markets. We're actively supporting those today, and we'll continue to grow in those spaces. Hillel, any thoughts about how Cross River is enabling this trend?
Sure. So the critical difference between an embedded finance company and a fintech company is what their prime focus is, right? So a fintech company really wants to provide financial services. Embedded finance companies, you could argue financial services is sort of the ancillary service that they want to provide. So they may not want to do a lot of the things that a traditional fintech company wants to do. They want to own the customer for sure, and we obviously are there to support that. But they look to us to do more services, and we see that as an opportunity to be more ingrained with our customers, do more for them. And so we are continuing to launch additional services that A fintech company may want to own themselves traditionally, but we'll do that for a fintech company. A lot of the back office operations, some of the onboarding, some of the compliance and regulatory aspects, while in addition providing the entire technology and other services that we traditionally offer to all of our clients.
Okay, excellent. So we talked about going global. We talked about embedded finance. Bet number 3. Bet number 3 is a really intriguing one. Fintechs will become full stack banks. Very relevant topic. Maybe to kick it off, I think that there's a lot of noise in this space. I would note that Cross River has always maintained that the best result is a partnership in harmony where fintechs and banks work together. The regulators get access to all the transactional activity. The fintech gets to operate with the speed and the agility that it's used to, and the bank gets to control the regulatory environment. So maybe starting with you, Hillel, I know your team is working really closely on watching this progress. Maybe give the audience a flavor of sort of what the options are for folks that are applying for these licenses and where you see this headed in 2026.
Right, so it really depends on what type of company you are and what you're trying to achieve. And what we sort of highlighted in the beginning of the conversation is that the regulators have actually laid out a slew of options depending on the type of company you are and what you're looking to do. So obviously they're the full stack banks, there's the ILC charters, there are trust institutions, there's the Fed Lite account or the Lite account that they call it. So they've actually given different options for a company. So if you're a traditional crypto company and you want to custody crypto assets, you'll just go for the trust license. You can go for the OCC charter also versus the Fed. There's all these different things that you could do. But at the end of the day, it really comes down to what the company wants to achieve and what they're looking for. As I said earlier, the difference between a fintech company and an embedded finance company is pretty wide. Most likely, embedded finance companies are not going to want to become banks, and they're going to work with a lot of different fintech companies to achieve that. You may be a fintech company and you might decide, you know what, I want to control all aspects of the entire stack from way down from a regulatory all the way up to the customer. We don't really see that rampant. We do see certain situations here and there, and we're obviously there to provide our services to those customers in any way, shape, or form. So again, it really depends on the type of situation and what you're looking to achieve. It's not a one-size-fits-all. First of all, the regulators are not going to accept every single company to be a bank, and just because you want to become one doesn't mean you're going to get the approval. So it's a tough thing to answer internally for yourself. You have to look at yourself and say, do I really want to do this? And if you do, what are you actually going to use it for?
Yeah, that makes sense. And Ben, you're in a unique seat because you're talking to regulators all the time, and you're obviously also working with fintechs as well. Maybe from your perspective, how do you see this evolving? Do you think we wind up in a place where there's limited charters being given? Do you think that the fintechs realize that this is not for them? Play it out.
Yeah, so taking a step back, I think it's critical to understand, again, Hillel hit on it briefly, but there's every day in the news seemingly there's another application or proposed application for a bank-like entity. So I think it's important to remember that a lot of these entities are, in some cases they are true bank charters and sometimes they are bank-like entities, and what they can do and they can't do with each charter differs. So Cross River as a fully chartered institution can lend and take deposits. Some of the, for example, national trust charters, you're not able to actually conduct all of the activities. So I think sitting in my seat, Adam, one of the things I think we need to all do, I think, take a step back and just really understand what the charters can and can't do and what they enable the fintech to do. And I think one thing that gets lost in the shuffle, it's great. This type of activity that we're seeing from regulators and policymakers allows technology and innovation to flourish. Mm-hmm. We were really closed off from being able to look at ways to actually enter the market. So I think it's good. It's just the overall narrative that we've talked about and we're hitting on. I think what's going to happen, to answer your question, is, look, sometimes when you go to apply for a license, you go ahead and you submit up, you hit the button, proverbial button, and there's a whole process that you have to go through back and forth with, submitting your policies and procedures. I think what we're going to find is some entities, the compliance and regulatory burden is significant, and decisions will be made to maybe we don't want to become a bank in the end of the day. But I want to be very, very clear about this. It's a positive development. There's actually a path to allowing fintechs to actually try and say, hey, I want to be regulated as on a higher level than I am now, rather than maybe at the state on a money transmission level. So I think we'll see some succeed, and we'll see some pull and retreat and just revisit their strategy.
The only thing I would add is that, I mean, not to get political, but like with the different regimes, you may become a bank, and it maybe look okay right now and everything's hunky-dory, but different administrations have different views on financial services and fintech in general,
It's a great
and
point.
you can get slapped around.
Yeah.
So everything could look great right now. You get your application, you move on, but you know, we've lived through a lot of administrations, a lot of ups and
Yes.
downs, a lot of different.
Yeah, there could be a pullback.
left and right.
I think
Exactly.
that's
We all know timing is everything, so I think that'll play a lot into it. I think competitively, we've always said, I think a lot of folks are telling us at least that it's a backup plan for them, and I do think that's appropriate. I think the other option would be adding a second bank, right, which I think can be clumsy at times. So I think that there is an element of like single point of failure being a protection against that.
Sure.
That said, I think the point is well made. A, timing really matters, regime really matters. And I think the success of getting through the process is tentative, right? I think that the fact that a regulator can look at a bank for accountability really helps, and I think it's a kind of a great ecosystem we've built so far.
And maybe just adding
yeah.
one more thing, I think we all want to place all of these different roles in like very clear-cut and neat bins. There's a bank partner, there's a fintech, and there's the marketplace or the brand. There definitely is a melding that has been occurring with these different entities. And I do think that like both of these things can exist in harmony. You can have a melding of bank fintech and then also bank partner in fintech. And to use like a Netflix analogy, right? Netflix produces its own content, but it also distributes third-party content. And so there isn't this necessarily we have to have all this, clear-cut X's and O's where there can be sort of us living in the gray.
Yeah, makes sense. There was an audience question on this topic as well, and I'll read it out loud. With policy priorities and government leadership continuing to shift, how do you see regulatory changes influencing innovation priorities for banks and fintechs in 2026? And maybe, maybe another question for the audience or for my colleagues here, but my thought on this question is that I don't think priorities change. I think the speed of the execution changes. And so like if you are relying on a bank charter or a license to do something, you'll be completely dependent on the timing of that approval. If you already have that product in place and this is a backup plan, no impact at all. But I think that most folks who I've spoken to are doing everything in parallel, and so I don't see any impact to any strategy, any planning, or priorities for banks or fintechs going forward. I'd be curious to hear from your seat. You think otherwise?
No, not much to add there.
Okay, great.
You hit it on it.
Okay, good. Okay, we've done through 3 of our bets for the year. Moving on to 4, and again, we're getting more intriguing as we go on. This one's a pretty broad topic, so I'll be clear about what we're intending to talk about. And the statement is, tokenized banking becomes real. I think last year we talked a lot about the crypto community. Actually, I was thinking before we started, no one's betting, no one's predicting on this webinar. And so we're not hitting any buzzwords. I'm just saying how a year ago we talked about crypto a lot. You're not hearing any crypto talk today. You'll hear stable coins, you'll hear prediction markets, embedded finance, but no, we'll get to one buzzword later on that I want to hit on. But I think that tokenized banking, now tokenized banking has so many different outcomes. I think it could be on the deposit side, it could be on the lending side. And so maybe starting with Noah, there's definitely a world, and I think Figure has been a leader in this space in terms of thinking about how the world can move to a more tokenized experience. How do you think the tokenization of banking impacts the markets you serve?
Yeah, I think just thinking about the financeability of digital assets is something that we spend a lot of time thinking about. There's obviously no shortage of headlines in the past year or so where you have really difficulty proving who owns what asset, where it's pledged, and then trying to unravel this thing is really a difficult knot to untangle. When you have this distributed ledger of lack of ambiguity of who actually owns the asset and it's fully auditable and fully visible to the world, I do think there is a really interesting corner to the market to both help finance infrastructure but also expand the asset classes that we finance. So for us, we're spending a lot more time on the financing of digital assets and I should say financing digital assets indirectly via crypto-backed loans where individuals may have assets that sit in a digital asset. They want to borrow against that. They don't want to sell, and are looking for some type of financing. And there's several players out there that are providing access to that, whether it's via a traditional consumer loan, whether it's access via a card. We think this is a really growing part of the market. And beyond the liquid nature of the collateral, just the not having to deal with the whole who owns the collateral, what, where, and why, I think is definitely something that's drawing our attention.
So maybe sticking with you for a second, because I think that you're hitting on some really good points. It seems like a pretty obvious use case, one that would solve a lot of problems, eliminate some level of fraud. I mean, I think that instance you referred to, I think fooled a lot of really intelligent folks. So I think that if you think about what it's solving for, it really should be a no-brainer. So maybe sticking with you for 1 second, what is stopping that innovation from expanding? Because it's really not expanded at the rate I think it should have or would have if I wind back a year.
Yeah, I think even going back several years, if you said where would we be in 2026, my honest opinion would be we have regular securitizations that are done across all asset classes on the blockchain. And so I think there definitely has been a much slower movement and transition towards this. The really unsatisfying answer is that there's a lot of incumbent infrastructure that exists today, and people are used to doing what they're doing. I think hopefully some of the instances like this year, the silver lining is people are starting to take a fresh look on, hey, maybe we should start doing things differently.
Yeah, I agree. And maybe I'll just skip down to Ben for a second, because I think that the blockers to this innovation specifically, I think I'm not clear on whether those are, to Noah's point, legacy processes, companies who have just a hold on the marketplace, or are there regulatory obstacles? Maybe Ben, from your perspective, where do you see the biggest blockers to adoption of this technology, given that it solves so many things?
So I love the way that you just framed it right there, is that technology. I think a lot of people forget with, whether you use the word crypto, digital assets, at the heart of it, when you break down, this is technology. Distributed ledger technology is just another way of allowing activity to enter the marketplace, whether it's financial services, consumer activity. So I like to think about it as like the way we listen to music changed over the years. I'm old enough to remember tapes and cassettes, and we went to Apple, we went to iTunes. I know, some age is sensitive, right?
Okay.
So but now I just pop up my phone and listen to Spotify. So I think if you use that analogy, it's the same way with money. That the technology changed, but in the end of the day, you're still listening to a song. You're watching something on TV. We talked about Netflix before. So I think. You have to remember that's technology. When people talk about stable coins, things like that, it is just technology and the way you represent value. But there are some blockers. There are some challenges, we'll say. And I do think it's right now this word tokenization is a little squishy. You have the power. People should never forget the power of incumbency. There are a lot of players who are entrenched, and the way that the world works today in financial services, for the most part, is pretty. It's consistent, and I think you have to think about that. The second is policy, and there's a lot going on in Washington, and I think that we need that to be resolved. We need regulatory clarity around whether, if you were to use blockchain technology to securitize an instrument, would that be a security? Would it be a commodity in some instance? So it seems like we're heading towards resolution on that. I think there was some action today. This week, and I think that will help resolve a lot of the ambiguity. But the power of incumbency is something we should never discount.
Yeah, I agree. So Hillel, maybe shifting to you. First, I want to hear your bet. Like, if a year from now, Noah said 3 years ago he would never have guessed it would have moved this slowly, but now things are innovating at a faster pace. Regulatory environment is a little different. Starting off with the first question for you: do you think a year from now we'll have made meaningful progress on the tokenization of banking?
Tokenization of the assets or liability
so
side.
That's question
that's
two.
The big difference.
Question two.
So I think on the liability side, we're seeing a lot there. Obviously, JP Morgan tokenizing the announcements that they'd had. I think you're going to see the rest of the larger financial institutions go that way. The community banks and smaller institutions, most likely not. It's much harder to get entrenched there and sort of get into their systems and enable that. On the obviously stablecoin. On the asset side, I'm going to be pretty negative. I don't think it's going to be. I don't think we're going to see a meaningful change in a year. We'll continue to progress, but I don't think it's going to be meaningful. We're going to see more and more on the stablecoin and sort of liability side. You see widespread adoption, widespread use. In the end of the day, the only thing you're really solving on the asset side, I could be wrong, you know better than I do, but really it's just cutting down fees and
fraud and ownership.
Some fraud aspects, but it's not rampant. Besides this one or two situations, like it's not a rampant problem to really focus on. It's creating more margin and reducing fees. On the liability side, you're really actually creating new products, new opportunities, new situations, and advantages for and opportunities for the consumer.
Okay, so fair to say you see the progression being faster on the liability side versus the asset side.
Yeah.
And so maybe question number 2 would be that Noah sort of articulated the benefits on the asset side. On the liability side, what are the main benefits to the customer, small business, consumer?
Right. So first of all, let's just say outright, like the consumer or end user has no idea what's actually happening. They don't know how the sausage is made, and they probably don't care about how the sausage is made. So whether they got the money via FedNow or RTP or via some sort of stable coin, they don't really care. They want it as quickly as possible, and they want it as cheap as possible. So then it becomes on the institutions in the middle to create those solutions. So the infrastructure there is more widespread, more well adopted, and that's why we're seeing wider use. Now, with the tokenization of deposits and stablecoins, you have the ability to have programmability with those deposits themselves, right? You're able to create rules. You're able to move the money around in real time, instant settlement, and move the funds around to create better situations for all parties involved. That programmability of those deposits and the ability to move them around into many different use cases, right? It could be a wallet over here. It can be a consumer account over there. It could be in multiple geographies. That opens a huge door and opportunity for all the parties that want to provide services to their consumers.
Okay. Maybe thinking about the policy front, I think part of policy is often driven by who it benefits. And I think a lot of these, I'll call it digital assets or crypto, stablecoin use cases really speak to folks who are using technology at an advanced level. I think the thought I had would be, and Ben, I'll ask you this question, is that I think part of the slowness to adopt or maybe change policy that would facilitate it might be because we're not necessarily benefiting the folks that regulators focus on, which is the lower end consumer and lower end small business. Folks who maybe have less savings, don't have as much cash, aren't buying crypto. So maybe from your perspective, and I know you have a background in digital assets as well, where are the benefits to that customer? Because I think that's what's not clear to everyone else. Like, we know the folks who are using it in a more sophisticated way are benefiting, they're buying assets, they're trading assets, but where is the benefit to the end user who's not necessarily as advanced or as affluent?
Yeah, I mean, when you think about you hit on something interesting. Bitcoin white paper is 18 years old, and we're now talking about probably our first tangible use case besides in potential stablecoin adoption, besides speculative trading. So I think it's been a challenge for the market to find an actual use case that consumers can benefit from. I think one of the challenges that we face as a marketplace is in the user interface and the user experience, where with traditional financial services, you're able to actually, when something goes wrong, pick up the phone and call customer service. I think we're getting there. There's a lot of solutions, but when something goes wrong with digital asset technology and on a ledger, the heart of it, it's immutable. It's irreversible, and I think that's a friction point to a lot of the adoption. And I think some fintechs are really starting to tackle that problem and how to make it a more user-friendly UI so that you can facilitate greater adoption. But I think as a prediction, I think we're going to get there. I see, and we look at a lot of customers and prospects that come in, and I think there's a lot of hope for the future in actually how do you meld the technology to the actual use case. I think that connector is really what's missing, and I'd like to say that's something I predict that we're going to see some more traction on this year.
Okay, you heard it here first. Fantastic. Very good. So moving to our fifth bet, and we'll get to other topics as well. And again, another big statement. But one thing that's been noteworthy is that despite some concern over perhaps consumer credit performance in the past, I think liquidity in those markets has been relatively strong. And so bet number 5 for us is liquidity stays strong across the capital markets. And Noah, of course, starting with you, I'm sure that applies very differently to various asset classes. Obviously, you have consumer, you have small business. How do you see that playing out from a liquidity standpoint and from a performance standpoint?
Yeah, I think from a liquidity perspective, obviously the big headline of the last several years is the proliferation of private credit. While I know there is sometimes some negative headlines that can be associated with the private credit bubble, which I find is ironic because no one ever talks about a private equity bubble when the private equity sits below the private credit in the capital stack. Yeah. But beyond that, it's created a lot more stability and durability and balance in the markets. If you think about the period just after COVID, a lot of the asset-backed market was financed by appointment, by 144A deals, and it was great when it was working, and it was terrible when it wasn't, and it wasn't really allowing for long-term stability for platforms and originators. Since then, it's created a lot more risk alignment between the originator of the assets and the buyer of the assets. And I think we had a really nice test last year during Liberation Day where markets went pretty haywire pretty quickly, and whereas in previous periods, I think you would have had people running for the hills, even us ourselves, who was a meaningful participant on the private credit side, we had more comfort to continue to fund, to continue to provide balance sheet, knowing that we had cushion and durability in the types of arrangements that we had struck with the platforms. And then from the platform side, obviously it gives them much more visibility into their future and their planning. Maybe for us in particular, I think we naturally sit between originators of assets and investors of the assets, and beyond investing off our own balance sheet, we see ourselves as a bridge between those two entities. And we're doing a lot on the advisory side, both for insurance companies who are meaningful participants in the private credit markets, but also for platforms who are looking to navigate and set up those arrangements that really allow for more long-term success.
Yeah, it makes sense. And one of the concerns to your point about being a more stable buyer of assets in fluctuating times, one of the things they write about is that perhaps some of those folks don't understand the credit they're investing in. And from your perspective, are you seeing that be the case, or you think that they're sophisticated, they know the asset class, and they're committed to it?
Yeah, I think it's more of the latter. The bilateral nature of these negotiations results in a much higher degree of auditing and diligence and getting underneath the hood, whereas in some other instances, you're sort of taking some third party's word for it. In these bilateral negotiations, these arrangements are usually a year to 3 years in nature. So by definition, there's just a lot of understanding of what is being done, what's being created that needs to occur. And to my earlier point, these arrangements generally carry some flexibility to them. If things go wrong, there isn't this, oh man, I'm exposed to that first dollar of loss. There is some cushion in place. Makes sense.
Okay. So those are our 5 predictions for the year. I think covered really well. Thank you all. Maybe one other topic before we get to our last and final prediction. I mentioned before buzzwords. The one buzzword we didn't cover today is AI. Right? You can't go through a webinar today without talking about AI. And so I think what we've seen in AI, and obviously we're a bank and a tech company at the same time, is that the innovation is a lot of times happening in the back office, is creating efficiency, automation, and so it's been limited, I would say, in impact in many industries. So maybe before we get to our final predictions, starting with Ben, I know AI helps your team tremendously from an automation perspective, but maybe how do you see AI moving from back office, perhaps to front office, in terms of a workflow?
Yeah, I think the maturity of the technology is actually, it's happening rapidly, so I think that's there. I think first off, there's no, in my role, overseeing the control function here at Crossover, I think you talked about a lot of the work that we do is around achieving efficiency and ensuring automation. There's no substitute for a good relationship with your regulator, so I think in order to move from the back office to the front, you have to be able to explain your use cases, and that not only to your regulator, to your boards, I think have clear plans on how you want to deploy the technology, and actually work with your business people to actually make sure that you're helping solve an actual problem instead of just using technology for the sake of it. So I think it comes down to relationships and how you're able to tie the technology to the actual use case.
You know, Hillel, aside from being our head of strategy, you're also the head of product. You own the product team.
Yeah.
So maybe from your perspective, where do you see the impact of AI today, and where do you see it a year from now?
So I'm just going to skip to my prediction, but I think for the most part, as you said perfectly, we've really seen it in the back office, automation, efficiency aspect of financial services. I remember back in the day when Upstart announced their AI model and got CFPB approved, and like that was the first like AI in fintech. We really haven't seen it. We haven't seen a lot of adoption in AI that actually affects the consumer and user that much. They don't see it. I'm sure there's stuff in the background that's creating more efficiency, bring prices down, bring costs down, which can be passed on to the end user. That's amazing. But at the end of the day, is the actual financial product changing for the end user? Is the actual service that you're providing changing? We haven't seen that yet. The one thing that we are seeing in the back office side, which I think a lot of people think can translate to the sort of front side or the consumer facing side or user side, which is really agentic finance, which is, can I actually have financial services or products be given and delivered to me and decided without me actually having to do that work? Can I have an agent sit next to me and literally just say, like with robo advisory, it's sort of like that, but more sophisticated, that it's like, nope, move your money over here, your account should be sitting over there, interest rates changed over here, this is the product or loan that you should actually be using, you should be, pay off this credit card, do that. That's the kind of thing that we may be able to see, which is pretty exciting. That's sort of my bold prediction, actually, just to skip ahead of that. And that's maybe what we see by the end of 26. I know, we jumped in. But that's the kind of thing that I could see or sort of envision in fintech with AI.
Yeah, I think a lot of it comes down to how you define AI, because I think to your point, we may not see it on our side, but we all know that like when you go onto Amazon or Google and you're looking for something, it makes recommendations for 100%. You. Many would say that's AI. Some would say it's not AI, but I think how broadly you define it will dictate whether it's impacting us or not. And maybe moving to Noah on that topic, I think I actually have seen, not to go against what you said, but I think a little bit differently. I think
it's supposed to be provocative.
A lot of our partners are using AI in credit underwriting, in alternative data, and I think that does have an impact on loan approvals, product delivery, money movement. And so I do think we're seeing the impact on the back end. We're not the ones creating the AI, but we're definitely benefiting from the AI. And so Noah, in your world, certainly, I think AI has a ton of use cases. And maybe you can talk about where you see it applying to your world.
Yeah, I think, when we talk to our software engineers here and they show us like the efficiency gains that they've gotten from AI, like it's staggering. Like their code output is like 3 to 5x, if not more, greater, and more of their time is spent reviewing as opposed to writing. And I think from my seat, more of like a traditional finance background, like the progress is like incremental at best. And so I think we stare at that with like what the engineers do with envy, but also optimism. For us in particular, I think about like credit due diligence, and it's a process that's arduous, it's long-winded, it's not standardized. And we talk about trying to build agents and products that help us go from data room to investment thesis in a matter of days, where we're reviewing and interrogating versus actually creating and building. And today that process takes us weeks, and there's no reason it shouldn't be condensed into a matter of days.
Totally agree. And I saw a demo 2 weeks ago internally by our data team, by Pravesh, that showed us exactly how, and Ben was there, how we can go and cut onboarding times in half by using AI. And we've already gotten them down meaningfully, and actually we're excited about this year from an onboarding perspective.
Very excited.
But I think to see technology, and he showed us only one example, that can literally ingest an item from a partner and review it and provide feedback with no one touching it, just by programming it, it was incredible to see. So I think a lot to be excited about going forward. Okay, so we're at the end of the webinar. We have to make our final predictions. So maybe I'll go in order. I'll make mine, and I'll pass it along to Noah, Hillel, and Ben. So on a positive note, I think for many reasons, I expect a lot of M&A activity in 2026. I'm going to make the statement that at least 5 meaningful M&A deals in fintech will happen in 2026.
You counting Brex?
Yeah.
Because then you're down to 4.
Yeah.
Starting from today.
Okay. There you
Starting January 29th until the end of the year, 5 M&A deals will happen.
I like it.
Noah.
onto me. I'll stick with the theme of predictions around markets and economics. I think we'll see above trend GDP this year. I'm saying 3% or higher. I think market consensus is more low to mid twos, but given the pro-business environment that we're in, I do think the AI CapEx investments are more structural versus cyclical. There's some positive tailwinds in the tax code. I think we're going to have, again, 50 bips of rate cuts this year. That all of this is really pointing to above trend growth.
So just quickly, again, as I said before, as I ruined it.
You need a new one then.
Yeah.
Find a new one.
That's all I got. Just agentic finance and having agents make decisions for you on the actual consumer and decisioning side of that, some adoption there. Not widespread, because I don't think we're going to be able to, I don't think that's going to be accepted, but just some adoption by the end of the year, a decent amount.
Okay, Ben,
Yeah.
since you own risk, you always get the last word. So you get the last word here also.
That's not always true. It's
How?
it's a partnership. Two for you. I think we're going to see the convergence of two technologies, artificial intelligence and blockchain technology. They are on a collision course to have they're going to intersect. The use cases are just starting to flourish, and we're going to have to attack them head on. The second would be that I think risk and compliance professionals are going to use AI within their everyday practices to meet their regulatory obligations. I think we're going to see increased adoption.
Okay.
I do.
I like it. Okay, you heard it here first. Thank you, everyone, for joining. Look forward to the next version of our predictions, either mid-year or end of year, and see you next time.